Is it smart to buy the same thing every month? This question is based on one of the most fundamental investment strategies: systematic and regular investing. This approach is especially common in passive and long-term investing. Let's examine it from the perspective of academic research, historical data, and behavioral finance. 1. What does buying the same thing every month mean? It usually means buying the same fund or index, investing the same amount every month, regardless of the price. This strategy is commonly used in broad index investing, such as regularly investing in large market indices, like the S&P 500. 2. What is the logic behind this strategy? 1. It eliminates market timing. Catching the market bottom is difficult. Even professionals often fail to do it consistently. Analyses from Vanguard show investing a lump sum upfront may be statistically slightly advantageous in the long run. However, systematic investing is behaviorally more sustainable. In other words, the mathematical optimum and the psychological optimum may not be the same. The cost averaging effect. When the market falls, you buy more shares with the same amount of money. When the market rises, you buy fewer shares. Over time, this creates an average cost. This is especially helpful for risk management in volatile markets. 3. The academic and behavioral dimension. Behavioral finance pioneer Daniel Kahneman demonstrated through the concept of loss aversion that people tend to avoid investing during downturns. But systematic monthly investing removes emotional decision-making, eliminates the question, should I buy now? Builds discipline. This is one of the strategy's strongest advantages. 4. Historical reality. What happens in the long run? For example, the S&P 500 has historically shown a long-term upward trend. If you invest consistently for 10 to 15 years, you contribute every month, the effect of compound returns becomes significant. However, one critical point: this strategy does not create miracles in the short term. First 2 to 3 years, it may appear weak. After 7 to 10 years, the power of compounding becomes noticeable. 5. Advantages of buying the same thing every month. Reduces market timing stress. Eliminates decision fatigue. Builds discipline. Automatically buys during market declines. Reduces psychological burden. 6. Is it always logical? No. In some situations, it may not be ideal. If you have a short-term goal, if you need the money within 2 to 3 years, heavy stock-based monthly investing can be risky. If it disrupts portfolio balance, continuously buying the same asset may distort your risk allocation. Periodic rebalancing is necessary. What if the asset is overvalued? Markets grow over the long term, but certain periods may involve overvaluation. But this raises another question: who can time that with certainty? 7. The professional perspective. John C. Bogle, founder of Vanguard and advocate of broad index investing, emphasized, it's not market timing that creates wealth. It's time in the market. This is where the power of systematic investing becomes clear. 8. Mathematics versus psychology. Theoretically, if you have a large lump sum, investing it all at once may be more advantageous over the long term. But most people accumulate money from salaries, make emotional decisions, get scared during downturns. Therefore, in practice, systematic investing is more sustainable. 9. The critical question: is buying the same thing every month logical? If you are long-term oriented, are patient, have chosen broad and high-quality assets, want to reduce emotional decisions, yes, it is logical. But if you want fast gains, constantly chase opportunities, are impatient, it may not satisfy you. Conclusion: buying the same thing every month is not a wealth accelerator. It is a wealth stabilizer. Its true power comes from discipline plus time plus compounding returns. The most important question is, am I trying to beat the market or grow alongside it? If your answer is the second, monthly systematic investing is a powerful strategy.